the Cali weather treating you?
I wouldn't know actually. Right now, I'm actually in Indianapolis. I'm helping. We have a project here for our Opportunity Zone Fund that we're working on, a minority business enterprise certified, and so there's some interesting stuff going on over here as well. So you'd be surprised, the Midwest.
Can you go into details on that, or is it some top secret project you're working on there?
No, so this is a legacy owned cement business. We're looking at, cement is an industry that is going eco-friendly, that there's a lot of opportunity if you're an MBE in, these states where there are not that many competitors. Our Opportunity Zone Fund is focused primarily on real estate, so I can talk about that a little bit more in our conversations, our follow-up conversations, but we're going to raise capital really for two fronts: raising for affordable and workforce housing, working with community-based organizations that are landowners, primarily faith-based landowners, the largest landowners in the United States. And then secondly, minority business enterprises with businesses that are owned and operated by minorities, legacy family businesses that have been around for decades and looking to, and are located or are operating in opportunity zones as well.
Who's this legend that I'm speaking with? What's your tombstone?
My name is Ifani Jemye. Started off my career USC graduate, started off my career on Wall Street in Citigroup in their city investment strategies team. So was doing a lot of factor-based investment structuring for all different types of private equity, private clients, hedge funds, and some high net worth from the private bank. Was fascinated with the quantitative side and was very quickly recruited into the asset management side, where I worked up through the mid-level as a portfolio management analyst and associate. And after that was actually during that time advising a few startups. Wanted to transition to become ultimately run my own thing. And so was working with a few startups. Actually, one of my city bosses from the FX division launched a startup, a cross-asset hedge fund that I was involved with, helped them with strategy, raising capital. And it was very fascinating because we were involved in cross-asset, commodities, as well as digital assets, FX. And so it was a very interesting opportunity, got me exposure to emerging technology in a great way. And I've always been a sort of an innovative minded person. And so I was recruited by an investment bank, global investment boutique bank called Johanny Associates, focused on capital raising for the early to middle market stage companies, really looking a lot at lower middle markets and primarily emerging technology across sectors. So healthcare, financial technology, and consumer technology. And it was really a great opportunity where we did a lot of capital raising. I probably did a few $100 million in transactions over the few years that I did that, primarily leading deals, originating deals, as well as, advising asset managers to raise capital and allocate capital. So we advise asset managers in the Middle East, in UAE, in KSA, Africa. We advise groups through some group organizations that we were involved with. And that's actually how I got involved in the impact realm. So during that time, while advising groups such as the African Union Diaspora Investment Forum, we were able to transition to be on the board of a few nonprofits focused on that region, and really began to practice and put into practice emerging technology to sort of help leapfrog economic development in those countries. And so from that experience, we learned really, they say when you work in the most challenging environment is when you're able to take solutions and import them into the less challenging environment. And so that's when we came back here to the US, me and one of my partners, and launched Conscious Markets Group, which is an impact investment and economic development company, currently raising capital and executing different advisory projects, both public and private. We advised the city of Berkeley last year on healthcare initiatives, kind of hybrid private public sector initiatives, and how they can extend budget to invest more in innovative preventative care and technology in healthcare, which resulted in two legislations being passed around social impact bonds and a health innovation zone that was launched in the city of Berkeley. We advise private asset managers in real estate on impact measurement and factor investing, on how to better quantify and measure impact investment strategies. And from that, we're now raising some of our own funds using our same strategies in the spaces of real estate and small business lending right now.
What would you say are some exciting stories that you've come across?
Yeah, absolutely. So, I think it's been, obviously, as an investment banker, we did a lot of exciting stuff, working on cutting edge type of deals, emerging technology, advising investment managers in the UAE, for example, Royal Group Abu Dhabi, groups that, had invested a lot in funds such as SoftBank's funds, and when groups when they take big hits on those portfolios from things like WeWork, I think, for example, one of SoftBank's funds, 60% was raised from the Middle East, and so they took a big hit on late stage investments, and they were really focused on they really wanted to get more early stage both acquisitions and investments to bring innovation to their region. And Africa has the same goals. And so we were working in these type of regions to help develop, we were sort of the cutting edge to bring earlier stage opportunities, helping with portfolio commercialization, acquisitions, as well as portfolio allocation strategies. And so we found that we were able to recruit numerous top asset managers, managing principals to our advisor board, to bring deals to them, to complete acquisitions in emerging technology, healthcare, regions where healthcare, there's a big gap in trust. And, there's a big need for preventative as well as new telecommunication type healthcare to kind of bridge that gap where there's a gap on the public side of what can be provided. And so was great opportunities to help stimulate challenging economies with that. I think actually some of the most interesting stuff I've done probably is actually when I went independent completely and launched Conscious Markets Group, and was still doing a few capital raises on the side, but I was trying to get more into the grant space to look at what will be pure impact financing, non-dilutive financing, and debt. We did quite a bit of debt as an independent, and so one deal that was exciting for me last year was I helped a international focus but U.S. based company called Music Battles Evolutio, which was a gamified. It had a TV show in Mexico, a game show focused on helping emerging artists sort of get their voice heard. And they had an app that would allow it's kind of like Versus. Versus in the U.S. was exactly like that. It was a show just like that. In fact, they predated Versus in the U.S. and so help them actually get an ecosystem grant to move a lot of their gamification app onto blockchain technology. And so they received a multi-million-dollar grant from the Hedera Foundation, which is a top 50 blockchain. And that was non-dilutive opportunity for an ecosystem-focused growth grant for Hedera to grow their ecosystem, leveraging this group's large commercial audience and rapidly expanding global television show. And so they continue to do raises. They're on to their next rounds, which I'm not on right now as their advisor, but, was able to close multiple deals like that last year that were very exciting around ecosystem development, impact, and really helping out to fill gaps. Because, when you look at artists and the ability to monetize their audience, there's a great utility that comes in with digital assets and blockchains, things like that. Whereas there are a lot of use cases that don't have a lot of utility with that space and can even be sometimes scammy. When it comes to music and art, there is a great utility with regards to monetization and giving people back the ownership over their data, their rights, their creative imagery, their creative music and content, and allowing them to kind of leverage their audience directly in a decentralized manner. So that was pretty exciting and interesting from the perspective. I've done a lot of different things in different industries, and so doing stuff like that is always pretty fascinating.
There are 3 pitfalls entrepreneurs must know before developing financial projections, and by not knowing these, it could lead to negative rapport with investors.
Mm-hmm. Very good questions. So I would say just off the bat, your financial projections should really improve your position at the negotiating table. Investors are always going to want to pick at things, and having a financial projections allows them to, first of all, have something that they can pick at other than things that are immaterial, and then also the ability to back that up with your argument, that's your evidence-based argument for your valuations. Number one pitfall is not having sort of the scenario analysis, not showing both the downside and the upside potential for the business. Whenever we do financial projection, you want to have scenario analysis there and risk analysis that shows the sensitivity of the valuation to various factors, and even sometimes as simple as variation of the discounted cash flow factors, such as the discount rate. You need to have something at least like that, and then you need to have additional scenarios if you want to be able to be at the negotiating table to be taken realistically. In a negotiation, you're always best to have a range. When you present your valuation, it's good to present a valuation if you have previous investors. But if you're going at a new round, at a new valuation you want to pursue, that range will be created by your bottom and your worst case and your best case scenarios. So you typically would have something like a best, worst, and base, and that provides a lot of negotiation power for you and opportunity to present and show that you've taken this into account in a very thoughtful manner. I would say another pitfall is using the being too aggressive or using the wrong market multiples in that part of your analysis. So not using enough triangulated ways to measure value. So when we do evaluation, we'll look at discounted cash flow, we'll look at market multiples, we'll look at asset valuation. So we'll look at different valuations, and that will enable you to also take an average or look at those comprehensively separately. So one mistake I've seen is companies not using the right type of multiples in their multiple analysis. For example, if you are expecting low profits or low revenues, looking at your competitors and using an EBITDA, a low EBITDA multiple when you're expecting low profits in the next few years is not a great metric to use for your market multiples. So picking the right variables is very important, that you want to tell your story and that fit your structure of your business. And it takes usually somebody with finance acumen to know which ones you will work with. And so as a founder, you should almost always hire somebody who is a financial professional to do your valuation model. I would say the third thing is being too aggressive. Sometimes a lot of startups, they try to show too many years. They try to show, too much growth that hasn't been validated. And if you're going to do that, make sure you have scenarios that show otherwise as well. If you show too many years, it can also, the question then comes in, how does this relate to my investor capital at this moment in time? One thing I try to advise is that the number of years being projected should be the number of years or close to the number of years that is supported by the current round you're raising, so that the investor understands that as new capital comes in the future, they're expecting an increase in your value, that you're not trying to capture, 20 years of future value as of today. So those are three pitfalls that I would consider as important for founders to consider.
And this initial conversation is supposed to be snappy. We're not here to take all day, but I want to also leave our audience with something that they can utilize and to get excited for the next conversation that we have with Ifeanyi, right?
Right, I want to give them everything.
Let's delve a little bit into costly mistakes. I know that there's several, right? If you could just share a few with us, mistakes that entrepreneurs make when they're in that raising process.
Really, there are a few. I would say a very big one is not managing your burn rate. A lot of startups, and they had a successful raise, they expect that, they project that out. They don't have very good budgeting. They spend a lot of money quickly. The best thing to do is be very conservative and dedicate your funding on your core activities and trying to commercialize and raise capital. It's very important because a lot of startups, I find, put a lot of money continually into technology and maintaining that technology. And sometimes they'll pay for technology before they pay for personnel. I'm someone, and that's our motto at CMG, is always invest in people and technology, because if your team leaves or if you don't have enough money to pay salaries, then that technology is not going to get commercialized. So that's a big one. Another one is not having a capital formation team. A lot of times founders will sort of just use their warm network and then not really, or hire one person and not really have a strategy to really maximize the two paths. It's good to spread your bets with your capital formation team, to hire multiple people, or to really have a very strong internal strategy for fleshing out the full network of the warm networks of the founders and team, supporting team, alongside whoever you hire for capital formation, especially if you're doing trying to do a M&A to sell your business or something like that. You definitely need to hire an advisor to run a process. Processes are very important. I would say also, being too inflexible. I've seen a lot of startups kind of go out of favor because the founder was too inflexible on the valuation and the amount they were looking to raise. It's very important to understand the minimum you actually need to raise with the corrected budget, and then also have your maximum as your target. but to pursue that minimum and try to get that no matter what, which means even sometimes giving concessions on valuation. Why? I've seen a lot of companies run out of money. And when you run out of money, you run out of steam. After you run out of steam, you enter what we call the stagflation phase for a startup, which is where you're suddenly looking for extension rounds, bridge rounds. You're not really able to get investors to see that uptrend in your business that is required to maintain a hot book of investors. And so it's very important that we are able to be flexible, because it's much important to not kind of sputter out as a startup. But if you do, the way to get out of that stagflation phase is to really pursue things like maybe debt capital, non-dilutive capital, or really trying to create a lot of commercial opportunities the best that you can, continue to push forward commercially, and then also just having some innovative investment structures, which is where it's good to have an investment banker that can come. They can you can offer preferred stock, things that won't bring you necessarily into a down round, but that can get you capital in the door. Other things is I've seen is that kind of goes along with that is being afraid to have a down round. That's part of that inflexibility, fear. And then rushing rounds. A lot of people try to go to the VC market and others before they've really fleshed out their friends and family. I believe it's very important to flesh out your warm relationships and your friends and family and your own money to show investors that you're fully invested and that others nearby you have bought into the idea. I understand that it's not always possible. They say a prophet is most disrespected in his own hometown. And so that it's not always possible, but it's very important to flesh that out the best you can, and for your team to flesh out their friends and family the best they can before they go to external investors. That's also how you retain value in the company and your strategy, right?
If I amazing. This is gold right here. This information that you're sharing, and I'm looking forward to our next conversation.
Yeah, absolutely. That's why I said I want to come on board and help you put out your first set of materials, educational materials, because I think that the impact could be tremendous. We have a lot of different type of colors, different type of ethnicities representing different type of geographies and places that we've been and worked, and so the world can really benefit from what you're doing. So keep it going.